Good afternoon or good evening, everyone, depending on what area of the country you're from. This is Lance Zimmerman with CattleFax, and we're going to get started with our CattleFax Trends Plus Cow-Calf webinar for today, May 23rd, 2018. Seeing quite a few attendees online and active tonight. Appreciate you all taking time in this spring season to get away from the operation and spend an hour with us participating in this discussion. Most of you, many of you have been on this at one time or another, and so technology is usually not an issue. If you can hear me okay, there is on the panel on the right-hand side a way for you to raise your hand. And I'd just love to see you go ahead and click that raising hand button if you can see me okay and hear me okay, so that I know the technology is good on your end. I'm seeing some hands being raised there. So it looks like all systems are go. I apologize if the connection's not great wherever you are. Sometimes those rural connections can be a real problem, but I'll go ahead and put all the hands down. Another functionality that I encourage you to use is the questions tool. Our panelists can all see those questions. We will address those at the end of the session. And as always, we want to be respectful of your time. And so we'll end this thing right at an hour as best to our ability. That doesn't mean we are not going to answer your question. You send us a question, we will even follow up via email to make sure that gets addressed. So with no further ado, I'm going to go ahead and dig into tonight's discussion for all of us. The four things that we really want to cover today in this webinar are essentially one, give you an outline for our market projections over the next 12 to 18 months. We want to highlight specifically the summer summer feeder cattle and fall calf markets. Ethan's going to review with you our recent CattleFax cow-calf survey results and some of the things that he discovered through that. And then we're going to turn it over to Elanco and Dr. White to discuss preconditioning benefits and best practices. So again, my name's Lance Zimmerman. I am our manager of analysis, research, and data here at CattleFax. And I'm going to just dig right in. We appreciate Elanco's sponsorship of tonight's meeting. They've been a dedicated sponsor for us. Ethan said we've been doing this since September 2014, and Elanco's been with us nearly every step of the way. And so we appreciate them helping support this, the cost of the technology, the time to pull all this together for you all to make it free of charge and available even online after we wrap up tonight's session. So as I dig into my portion of the presentation, I'm really going to focus on a market outlook for all of us tonight. As we dig into this discussion, it's important to me that I think we talk about weather. Weather has absolutely wreaked a havoc on the markets, whether you're talking about what's gone on the cattle side of the business and altering some of our supply shifts, but even on the grain and feedstuff side. We've talked to you before about the 3 cardinal rules and how when those are violated, they can have a negative technical aspect to the entire marketplace. And we're going to talk about some of those, that many of them are rolling over, and it's not in a good way. And we'll talk about the risk that those factors play in the marketplace over the course of this next fall and all the way into next year. And then we'll focus on supplies. Obviously, we're not expanding at the rate we once were, but supplies are still growing, and the effects of that growing cow herd the last few years are still creeping through the production system. And so we'll talk about supplies as well. As we dig into this, I think it's no secret to any of you all that the drought monitor has been saying our country is in some pretty tough shape across some major cattle country. When you look at the shaded areas, I think we're all familiar enough with this map to know that the red areas and orange areas are bad. Yellow and light tan areas aren't certainly good. And if it's white, you're in the clear. And as you look at this map, it's important to recognize that those areas in light red or worse cover about 10% of the contiguous United States. Those areas that are orange or worse are right almost at a quarter of all of the country right now. As we look at this, this has influenced not just our supply of cattle. We've shifted a lot of cattle that would typically have been coming off of wheat pasture at this time. We've already shifted those cattle into feed yards as early as the start of the year. It's also influenced a lot of what's gone on in our feedstuff markets. And I think as we look at that aspect, and we talk about that a little bit later, one of the natural progressions for people to talk about is, as it's affected feedstuffs and pasture, what does this mean for our cow herd? And as we look at it, I think that story has yet to be written. As we talk about cow-calf expansion, that we still are forecasting a slight expansion across the U.S. this year, but it's not near to the extreme that it was in 14 and 15. It's certainly approaching stabilization, but we would say it's not approaching contraction yet. And two things that we've talked about often that influence contraction and expansion are what's going on with the weather and what's going on with cow-calf profitability. And Dr. Art Douglas, many of you are familiar with, he is our in-house meteorologist, been with us almost from the start of CattleFax. And this forecast is really summarized here. And what I'll tell you is, as you look at this graph and what's going on here, the left side of the panel, or I guess basically the center of the panel, is essentially the temperature anomalies by month, June, July, and August. On the other hand, you got precip anomalies over here on the right. And again, June, July, and August. And what you'll see on there is red's bad. Means hotter than normal, drier than normal. Blue, especially the dark blue areas, mean wetter and cooler than normal. And what you'll see is we're making a transition. We're making a transition from a La Nina market environment from a weather perspective to an El Nino. And El Nino means instead of the hotter, drier temperatures that we went through for basically the last 12 to 18 months, that we're going to be transitioning to cooler, wetter temperatures, particularly as the summer wears on and especially as we get into fall and winter. And so as we look at this, the bad news is once you get past May 1st across major cow-calf and stocker country, you usually don't catch up. And we're entering this main growing season dry. And that's what the feedstuff markets reflect. That's what the cattle supply shifts all reflect. If there's good news in this situation, it's that the trend is turning. But we're probably not going to get the pump primed back up and things looking wet again until we get to the end of this year. And so as we look at this situation, it's probably not going to change our fundamental supply forecast too much. A lot of the big changes have probably already happened in the marketplace. We probably have enough pasture to get us through the summer. We probably have enough feedstuffs to get us through the summer as well. But that means that in order to get those supplies in the right places, some areas of the country are going to have very expensive feedstuffs. And so as we dig into that discussion with just a little bit more detail, I think you'll see our hay price as we look to next year, it's going to be very elevated. As we look at this graph here, what we've done is we've chopped it out in market year. And so what you'll notice across that bottom axis is May 1 of every year is the start, and then April 1 of the following year is the end. We don't have April prices posted just yet. If I was a betting man, those prices on a U.S. average basis for all hay, whether it's basic grass hay or high quality alfalfa, are probably going to be a weighted average in the upper 150s. And then you'll see the price forecast that we have charted out through the next year is a full 11 to 12% higher than where we were in 17 and 18's market year. Hay prices, as we went from 16-17 into 17-18, we're up about 6 to 8%. Hay prices are going to be a lot more elevated. You're going to see hay changing a lot of hands, and pasture rates are going to be reflective of those increases as well. And that's going to be a challenge for us as cow-calf and stocker operators because we're going to have to manage our cost side of the ledger sheet a lot more closely than what we became accustomed to in 15, 16, and 17. And so as we go through this, our projection is those margins are going to get a little compressed. And those break-even costs where we typically would have them on a national average around $140 a hundredweight for the average U.S. cow-calf producer are probably going to creep up a little bit as we work through this year and into next year because, one, hay supplies are a little tighter, and with the expansion we've gone through, there's more mouths to feed. Obviously, as we talk about it from a hay perspective, things aren't much different as we talk about it from a corn perspective. And I know basis levels can be a lot different for corn across regions of the country. So we just put December corn futures here, focusing already on that new crop. And what you'll notice very quickly is prices are significantly higher than where they were last year. Last year, it seemed like we could just carve out a range between $3.75 and $4 this time of year, and we weren't going to get too far out of it. We're already sitting here in the low 420s on a December corn contract. And risk, as we look at it before we get through this early summer period, is probably sitting up here in the 430s, maybe even 440. As we go forward, that risk probably breaks down into the upper threes. And there's a couple dynamics at play. One is weather, where it's been hotter and drier through some of the major cow-calf country, especially in the southwest part of the United States. We've been in a cool, wet pattern locked in the Corn Belt. Delayed corn planting, much past that magical April 15th date, has really caused a lot of concern out there in the marketplace in terms of how damaging has this been to yields. We're getting hotter, drier temperatures through the Corn Belt right now. Our opinion is the yields won't be damaged too much, but we already planted less acres to start the year. And so one of the magic numbers you've heard us throw around is stocks to use. It's essentially how much residual corn do we have available in the bin at the end of this crop year after we account for all the demand aspects. Coming out of 14, 15, 16, and 17, it was very customary to see that stocks to use level 13, 14, 15, 16, 17%. Estimates from the government right now are that stocks to use level for this next crop year are going to be around 11 to 12%. Little less supply due to less planted acres, maybe not as bullish of a yield expectation as we've been used to the last few years. And so as we look at this total market picture, little more demand, little less supply. The demand's coming mostly from more feed and residual use. Little stronger export demand has potential as the U.S. is a big player in the global markets this year with tighter stocks in other areas of the country, Brazil going through a drought, Argentina struggling, and likewise. And as we look at it, gas prices and oil prices have been high enough that ethanol production is very profitable and going to pull more corn probably into the energy markets than we've seen in recent years when we've had cheaper energy. And so we're going to be watching that all closely. But again, much like the hay situation, our corn market's going to be higher prices as well. Why would I start the discussion out talking about hay and corn? Well, obviously, they're feedstuffs we're watching. But I think as we talk about your guys' market, we also got to recognize that higher feed prices can pressure feeder cattle values. And what we have here is the spot feeder cattle futures contract, today's feeder cattle contract price, against the third contract out live cattle futures. So we're basically making the assumption that feeder cattle today are selling as live cattle 6 months from now. And what you'll notice on this graph is, for all intents and purposes, we're at the highest levels that we've been at since late 2015. These feeder cattle prices relative to the deferred live cattle have gotten an awfully large premium in them. None of us are probably real happy as feeder cattle sellers with where these cattle are priced today. Certainly, we would expect a little more liveliness in that marketplace going into summer, and we're used to a seasonal rally into Labor Day, and the market's pretty much stagnant right now. And this is one of the reasons why. There's a lot of pressure on this marketplace from corn, a lot of pressure on this marketplace from some other factors that we call those 3 cardinal rules. And we'll talk about that in the next few slides. If you're not familiar with the 3 cardinal rules, there's a couple aspects at play. One of the things that we talk about with the 3 cardinal rules is it's bearish to the entire cattle complex if cattle feeders are selling cattle at a loss. And what we have here on this particular graph is very simply what is the weekly average CattleFax fed cattle price in the red line. What are futures implying with a basis adjustment, so converting that futures price to a cash equivalent going forward? And what are our calculated break-even costs on those cattle? And what you'll see is as we made the transition from April into May, we're not forecasting a profit for cattle feeders going forward if these futures prices hold. And we're of the opinion that these futures prices are incredibly oversold today. When we look at the marketplace, it's behooved Chicago to take a slant that they're just bearish proteins, whether it's feeder cattle, live cattle, or even lean hogs. The market's incredibly oversold on the futures side, in our opinion, much more so than fundamentals would suggest. But even if you say cash market needs to be $10 higher than what futures is projecting today, you're simply taking these prices and getting them back to a break even in many, many instances as we look out forward. And so as we look at this today, we're projecting $100 losses based on futures prices. And that's one of those factors as we look at this feeder cattle market has certainly been limiting its ability to have a seasonal rally and robustness to it like we would sure expect. Another concept that is certainly a risk factor as we look at our what we call 3 cardinal rules is what we call the swap. And the swap very simply at CattleFax is what is our current fed cattle price relative to the purchase price of those cattle coming in and their break even. When their break even on those purchase cattle coming in exceeds the current fed cattle price, we call that a negative swap. And in these periods where we've seen negative swaps, it's that fundamental idea that we've heard all too often of betting on the come, right? Buying that animal on a loss, betting that the market's going to come to you in 4, 5, 6 months when you sell it. Cattle feeders are having to start to bet on the come again when we look at this swap. And when you buy a loss this time of year on the swap, it's very hard to get that animal to be profitable by the end of the year. Typically, the market does not perform enough to offset the loss that you bought the day you brought that animal in. And again, it's another one of those signals that we're watching that tells us we might still get a seasonal rally to feeder cattle, but it may be pretty underwhelming. Another aspect that we're watching, and this has relationship to the 3rd cardinal rule, which I'll bring up on the next slide, is supply. The reason Chicago and the reason the markets are bearish, these fundamentals, is because they're concerned about the supply that exists today. And when you look at that upper left graph, this is current fed steer and heifer slaughter. The last 3 weeks have basically been 3-week highs in this phase of the cattle cycle for fed cattle slaughter, higher than any point last year with that most recent data tick. And this week's slaughter will probably be at or above this current week. But what the market's also looking at is the fact that we placed a lot more cattle out of that available supply through the 4th quarter and the 1st quarter of this year, to the point where the cattle outside of feed yards on April 1 is actually 500 to 600,000 head below year-ago levels. The cattle are already there. And what it means is as we work through that supply, on-feed inventories are going to tighten. We're sitting here today 800,000 to 900,000 head above year-ago levels on feed. But those cattle are coming to market now. June through August will be our peak. As we work through that peak, that year-over-year gap in on-feed numbers is going to tighten based on our own forecast with that dashed line. And as that happens, with these tighter placements that we've seen in March, April, and we're likely to see again in May, the market's responding. And it's put a big premium out in December relative to today's spot market. And what that means for you all is we have a cattle feeder that recognizes he's losing money. We have a cattle feeder that also recognizes every animal he brings in the yard is likely to lose money, but he sees the market dangling a carrot in front of him out in December. And so an animal that he normally would have marketed in August, the market's telling him it'll be worth a little bit more if he can feed it into September and feed those September cattle into October and those October cattle in November and so on and so forth. And so as we look at this situation, this is the 3rd cardinal rule. You can talk about it relative to basis or you can talk about it relative to spreads, but you have a futures market structure that's set up in a way that incentivizes the cattle feeder to kick the can down the road with his marketings. Add days on feed, add weight, and the risk is potentially add uncurrentness into the marketplace. So again, just for review, you have break-even costs that are exceeding today's fed cattle market. Losses happening in the feedlot segment. And you have a spread structure set up in a way that's going to encourage feedlots to add weight. Those three cardinal rules are all in the process of rolling over. Now it's early. They can be all three negative and work against the market short term, and they can correct themselves in 30 days or 40 days or 60 days and not cause much harm. But if this structure continues to exist, it has the potential to spill over and adversely affect the feeder cattle and calf markets. The good news, bigger picture, is the market fundamentals actually look very good for the cattle industry when you get past the feeding and packing segments. In fact, packing's profitability is at a high right now. The packer needs incentivized to move all these cattle that exist through the system. And so they're making great money right now because we got to make sure that they have enough money to pay the added labor and get the product moved through the system. The other segment that's not doing all bad is retail. Their margins are much more compressed this year than in years past because they're fighting amongst themselves more. We're getting that market share battle you would expect after a couple years of prolonged profitability, which was certainly the case in 16 and 17. Now, retail prices appear to be holding that normal after a couple of years of sharp declines. And we're going through a transition as we get to summer. It's our projection that these retail prices are going to be very comparable to 16 and 17 levels through the entire second half of the year. And as that happens, that has a generally supportive factor to the cattle markets. What it essentially means is, as we build this supply and the market wants to discount the future like it has, the cash market can have a way of bailing out the supply at distress. Somebody steps in and says, I see value at these prices and I'm willing to buy them. And that's essentially what these retail prices are doing. If these retail prices do stay where we have them projected, our cattle market doesn't have to get too weak. And that's illustrated on this bottom graph. The CattleFax 550-pound steer calf price is a percent of that all fresh retail. When you look at that, that's represented by this orange line. And what you'll notice is there's an area of long-term support, basically plus or minus 28%. And what you'll notice is there's only two places where we significantly broke this down. This was the 08 recession, and this was the blow-off bottom in the cattle markets in late 16. If we assume that we can find support at 28% and that these retail prices in the fourth quarter are somewhere around 560 on average, it suggests calves should find support somewhere in, I would say, the low to mid 150s. And that really shapes up some of our expectation as we look at this market going into the fall and even into next year. We believe there's undoubtedly supply pressure in this marketplace going forward, and that's going to continue to exert itself into next year. But when we talk about prices, we got to talk about them both in terms of what we expect over the next 6 months and what we also expect and realize as the fundamental risk due to growing supplies going forward. As we look at this feeder cattle market, I think what we should expect is a seasonal rally, as we see in this green line. But what we got to understand is we might have to break this market down lower before we go higher. And what that means is we might have to be in a situation where we test on the 750 weight market some of these prices down here in the mid, maybe even low 130s. And then we have upside potential as we get to spring back into the 150s. So it's a huge range, but I think it's because we recognize that as this cattle market on the Fed side continues to get cash to come down to the extreme futures declines that are there, we're probably going to get some pressure exerted on the fundamental markets outside of the Fed cattle side. And then on the calf side, I think as we look at this market, the risk as we get into the summer videos is kind of following a trend very similar to what we would have seen in 17. Corn prices, available supplies, and the like probably are going to sit back and cause this market to be more supported on the front end of summer for summer video sales than the back end for these fall delivered calves. And as we get into fall, I think our risk is not just probably back down here to 155, but maybe even into 150 If things get a little bit more bearish and regional supply factors become a real challenge, we get flushed with a lot of fall weaned calves, you could even have some supply risk that potentially pushes prices into the upper 140s. But I think as we look at this calf market through the summer, through the fall, this range from the low 160s into the upper 150s is going to hold for those of you who like to get out in front of this market and get these calves contracted early. A lot of questions always come up. They're outside the scope of today's presentation, but what if President Trump has a wild tweet? What if we don't get a trade agreement inked with NAFTA or some of these other trade partners? That's why I put the graphs on the right. We have to recognize that our fundamental risk is still where we carved out lows in fall of 16. 120 on these heavier feeder cattle, potentially even the mid 120s on these calves. We don't foresee any challenges like that happening, but we certainly got to recognize that there are risks in this marketplace. And so with that, I will turn this over to Ethan and allow him to dig into the survey results.
Thank you, Lance. As we wait to switch screens here, I want to thank everyone for showing up and being a part of this. We always appreciate it, and I want to thank Elenko as well for being part of this webinar series that we can put on three times a year. It's a big deal for us, and we really appreciate their support going forward. Like Lance said, my name is Ethan Oberst. For CattleFax, I covered Northern Plains and Western states for cow-calf and stocker operations. Deal a lot with the unattached markets, and that's where the cow-calf survey comes in. So I am the individual that puts out the cow-calf survey, analyzes a lot of that data, then disseminates it among our membership and outside of our membership at some certain points as well. So what we're going to do here is that we're going to get into a little bit more of the details. We're going to talk through it, but first I wanted to start with a general overview, just so we're kind of all on the same page about what the cow-calf survey represents, kind of what the sample size was, so we can kind of get some background information on there so we all know where we stand. This year, the average cow herd size was right here. Apologize, I'm trying to get the pen here. Was 527. The average cow herd size on the survey was 527. Cow costs did not unsurprisingly move higher. They moved about $15 higher relative to they were in 2016. A lot of this had to do with winter feeding costs. We'll get into regional costs here a little bit more, and you can see that there's a difference in the regions, and a lot of those regions had some issues going through last summer, as well as tough winters this end of 2017. And I know this is obviously a 2017 cow-calf survey, but also looking at 2018 was a rough start to the winter, rough start to the year. Calf revenue did move higher in 2017 relative to 2016. By this data, it was about $70 higher. I know some instances, in the fall, when you look at fall of 2016 versus the fall of 2017, we are $40 a hundredweight higher. So there was, several instances there where, probably operations turned in, better than a $70 improvement from 2016. But on average, when you calculate where we were through summer video sales, as well as those fall delivered or fall sold calves, we're about $70 higher on the average calf revenue. That puts it, basically $11 a hundredweight on a 550-pound calf is what that puts it at. Average weaning weight did make a considerable jump this year. I think the last 2 years we probably made about a 2 to 3 pound jump. This year we made a 7 pound jump. A lot of that could be said to really the adequate grazing conditions that we saw across the majority of the country. And I know regionally we did struggle with some of that, especially in the Northern Plains last year. But the majority of the beef belt did have adequate to better than adequate grazing conditions. So you could point to that a little bit as to the jump in weaning weights as we saw in 2017 versus 2016. Also, want to touch bases here. 88% of operations continue to expand or keep the cow herd steady in 2018. This is obviously a question that was asked in 2017 or beginning of 2018. So, we have a long way to go through 2018, whether that comes to reality or not. But also the same, regarding the same question or same answer, I should say, 94% said they plan to keep their cow herd steady or expand in 2019. So this is something we've been tracking here over the last several years as we've done this survey. We just kind of keep tabs on what the operations are looking at, what their feelings are, and what their plans are going forward. And you can see right now we continue to expand here in 2018, or at least keep the cow herd steady, as Lance alluded to earlier. So getting into the regional cow costs, here we, you can see there's, difference here in regional cow costs. In the Northern Plains, we do have the highest cow cost of any region. We kind of competed with that here in the Corn Belt region as well. You can see there the largest jump was in those two regions of, basically $40 there in the Corn Belt region, and just under 20 or just over $20 there in the Northern Plains. A lot of it has to do with feed costs. Obviously, we were dry there in the Northern Plains. That increased feed costs both from a supply or hay supply standpoint, as well as just a demand. Winters were a little bit tougher there. We had a little bit more demand of feeding cattle or cows through the summer. Into the fall, had to feed them starting a little earlier than what we normally would, as well as the Corn Belt. That region is the region of all in the United States that probably feeds the most or feeds their cattle the most, just due to their conditions there, and type of type of operations that are run their environment. You can see the rest of these operations had small increase. Southern Plains had, looking at basically, $12 increase. The out west and then southeast both had $3 increase. So basically steady. We do anticipate the average, the U.S. cow cost increase this year. A lot of it has to do with just the winter we had in the Northern Plains and Corn Belt, feeding longer than what we anticipated. Like I said, alluded to earlier, and Lance kind of talked about earlier as well, is higher hay costs than what we anticipated coming into this beginning of 2018. And then you can look at the dry conditions in the Southern Plains. Hay costs are going to be higher in the Southern Plains, and then parts of the west, or Southwest, I should say, just due to the dry conditions there, feeding cattle more, and then a lack of supply on the feed side. This is something that we put together just to kind of frame up or kind of put some brackets around the average cow-calf profit or loss, or kind of where their profitability is from a year-to-year basis. You can see there the last yellow bar on the chart is the last year that we, or should say last year, and you can see that it is a little bit higher than what we were, or quite a bit higher than what we were in 2016. A lot of it had to do with the increase in both the summer video sales as well as the fall calf market. And then we're looking at 2018 basically be back on par with 2017. I'll see the market correct a little bit, probably not make as strong as a run in the fall of the year like we saw last year. The other things that we kind of do with this chart is kind of put a high return or in a low return than average return producer here on this chart. Basically, kind of that table at the bottom highlights where we are from a cash cow cost standpoint. And I don't want to sit here and say the lowest cost producer is always the highest return. They do have higher odds just based off the data to be that type of producer. It's not always, the case. We kind of look at it in a case-by-case scenario. There are some operations that have high return. They fall in the high return category and they have higher costs. And basically, those operations have a cost-benefit ratio that's beneficial and it's working in their favor. So they're getting paid more for, they're getting paid at least $1 and a penny for every dollar they spend kind of mentality. And so you can kind of see there, those are the calf break-evens for last year based off of cow costs. Cow costs are going to be higher. You can probably add, $4 to $5, maybe $10 a hundredweight to some of these levels here on the right-hand side of the chart underneath the calf break-even. And I apologize, guys. I'm not getting my my pen to work here, so I apologize. That's why I'm not circling anything, and I do apologize. But we'll push on here and keep going. So what this is basically we're looking at a calving interval sorted by returns. So what this is the majority of a cow herd that calves within 0 to 45 days from their calving start date. You can see here 46 to 60 days and so on. What we find is the highest return producers typically have the highest percentage of cows that are calving within the first 45 days. This is something that's not a secret. The older the calf, the heavier it weighs. Basically, that is what you're looking at. Not only earlier she have her calf is within the breeding season, that means she also has more time to recover before the bulls get turned out. Is basically how that works. So use just a general rule of thumb of 2 pounds per day of age on a calf, and I know that they don't gain that in the first week, and they probably don't gain that through some of the hot times during the summer as well, or along those instances. But on average, probably 2 pounds per day of age. An extra 10 to 15 days is an extra 20 to 30 pounds that we can put on each calf as we go forward. So this is the weaning weights based off those calving length intervals. So this is kind of what I alluded to earlier. You can see here operations that calve with 0 to 45 days have a higher weaning weight by just basically 15 pounds. We're basically right in there at 15 pounds, a little over 15 pounds. So we're right at 15 pounds, I should say. Right 15 pounds. So if we use the 2 pounds per day of age, that is basically right there at 30 or we're in there several days, calving several days early on this. And as you can see here, there's a linear curve to this. You can see the longer the calving season, the lighter the calf is that's weaned. So also on that same subject, I should say on the weaning weight subject, you can see here that the highest return has the highest weaning weights, and the average return, this is the steers, but the same works same for the averages as well, or the heifers. The operations that wean more pounds, you can obviously spread out cow costs over more pounds of calf, and as well as you sell more pounds. It is kind of a take two birds with one stone kind of mentality there. So, and now this is not to say that we need to go out there and chase weaning weights, but I think there are definitely some things that we can do within our operations, like calving earlier within the calving cycle, getting our cows in better condition, so they do breed back earlier, they do produce a little bit more milk, some of those things. Some of those things that we can do increases efficiencies without necessarily chasing the weaning weights, chasing the larger framed cows that we've done here over the past several decades within the beef industry. Not saying that's a negative, just we got to be careful chasing weaning weights. So the next thing I want to talk about is calf crop percentage sorted by returns as well. So you can see here the trend. We look at a low return, average return, and high return producer, and then compare those against the U.S. average. So with the 2017 data, every percentage point that you increase your calf crop percentage, that is basically a $14 positive swing into profitability, or $14 better off that you're going to be, or added to the bottom line, however you want to say that. So when we look at the difference between a high return producer at 91.5%, and we compare that to an average producer, we'll just round that up to 89.5%. You're looking at roughly $30 in advantage just to have that 1 or 2% increase in calf crop percentage. And how that works is, like I alluded to earlier with weaning weights, is not only are you weaning more calves, that is you're weaning more calves per the number of cows exposed the year prior is how I look at calf crop percentage. We're also spreading out more of those, especially those fixed costs, across more cows. When a cow does not rebreed, she is basically costing an operation and not contributing, and she's basically adding her fixed costs to the entire cost pool, and not really adding to anything to the profitability pool or the revenue stream, I should say. So every percentage here in 2017 was $15. So you can see the difference between a high return producer at basically 91.5% versus a low return producer at 87.5%. You're looking at 4% or $60 a head difference in profitability that we're seeing between those two operations. You can see the trend here. Higher return operations have a higher percentage calf crop. Weaning length. This is something I did want to touch on. It's a little bit of a confusing chart, so I'll just kind of talk through it real quickly here. So what I have done here is, above each line is basically the value of the calf for that category. So a calf weaned from 28 to 45 days in 2018 brought on average, or the weighted average was $870 a head. A cow or a calf shipped off the cow in 2015 on average was $1,244 a head. So that's kind of how you read the chart. So it can be a little bit confusing there, but basically the point of this conversation is you were worse off weaning for 28 days or less than 28 days than you were shipping off the cow. Anymore, the industry standard is really a 45-day weaning period, and that's kind of the market. Anymore, you don't really see premiums necessarily for weaning. You will see premiums for certain weaning protocols, for certain weaning, vaccination programs along those lines. But the market anymore really demands cattle be weaned for at least 30 days and preferably 45 days. That is the market. Any cattle really under that is discounted. And like I said earlier, you were better off or very close to not wasting your time, costs, and energy by weaning your cows if you're going to do it for less than 4 weeks, basically. Not only do we put more weight on cattle, we get they're accustomed to feeding out of bunks, feeding out of feeders, drinking from automatic waters, tanks, some things like that, as well as we start to put some weight back on those cattle. It really takes over that 30 days into that 45, 60-day period to really put weight back on those calves after they've been pulled off their moms. I did want to touch a little bit on bull purchase price. Genetics, this is, before I get started, this is the same format of the chart that we saw on the weaning length. Each year it is the calf value for each category or each price of the bull that was purchased. Basically, I just wanted to point out here that genetics do count. Operations that buy better genetics, that use better genetics on their cow herd, and then advertise those better genetics, they do get typically paid more. You can see here, I'm not partitioning anybody to come out here and buy bulls on average over 6,500, but you can see these operations compared to other operations back here in the 65 and under do bring more money on a per head basis, on a revenue basis. Now, does that equate to more money in your pocket? Yeah, it does. When you're bringing in $100 a head more a calf, you can, and that that bull is breeding, 20 to 25, 30, some operations 40 cows. You start spreading the additional several $1,000s over those cows over the life of that bull, and that $100 a head difference in revenue and a calf does pay off. I'm not saying you need to go out there and spend $10,000, but I think the main takeaway from this is you have to advertise those genetics. If you're going to use those genetics, you're going to pay for those. Advertise that. Advertise if they are reputation type of genetics, and whether it's Angus, Charolais, Hereford, anything along those lines. Advertise those, and feedlots really do pay attention to that because they want performance, and that's one way they can kind of bail themselves out as well as have the cattle outperform their projections. Something else I did add this year is I kind of asked the question of number of calves expected from a bred heifer. So if you had a bred heifer in your cow herd, what would be the expected number of calves that she has? And you can see the majority, typical kind of, bell curve here. And I need to add a little bit more, answers here to this question. And we'll do that next year. But you can see typical bell curve. Majority of in here is from 6 to 9, and that's kind of what we use for an average. Actually, the average useful life in the number of calves that I found, the weighted average was 7.81. Now, obviously, I understand you can't have a 0.81 of a calf, but just looking at it from a statistics basis, it was 7.81, and that makes sense here. So that's basically that. This is the 9-year-old cow. If she's having her calf as a 2-year-old, this is a 10-year-old, and so on and so forth. A number of calves here. So that's kind of one way we can calculate depreciation, as well as just I kind of wanted to put that out there. If you're down here kind of in this 4 to 5, we probably need to do something different and increase the number of calves, whether it's from nutrition standpoint, whether it's from giving a little bit earlier and giving them a little bit more time to recover before we turn out the bulls. Something along those lines, we probably need to look at our operation, and operations are out here that are 10 plus. They're making money on those older cows for sure. one second here. Does anybody see my screen? I just went blank.
Yeah, Ethan, it did. Try backing up one.
It is not letting me do anything here. Hold on one second here. I apologize for this. I was almost done, and it looks like my computer has frozen. I believe I just had one more slide, and I can talk through it before Dr. White comes on. And that chart was looking at that. It was basically the number of operations that plan to expand in 2018. What that chart showed is basically a decline in the number of operations planning to expand over the last 3 years. Still plenty of plan on expanding, here over the next several years. But what that's showing is basically that rate of expansion has slowed down. So I do apologize about my technology malfunctions here. I'm going to introduce Dr. Frank Joe White from Elanco. We appreciate him being on with us here. He is a technical consultant with the beef unit from Elanco. We do appreciate him being on with, and I will change screens over to him and let him take it from here. So I thank you for you guys' time, and we'll let Dr. White take it from here. Dr. White, I believe it's heading your way.
Thank you. As I switch screens here, I appreciate the opportunity to discuss preconditioning with you. Can you see my screen?
Yep, sure can. You might want to put in presentation.
Great.
Yep, there we go. Perfect.
There we go. So preconditioning is a management tool that I believe in. I think it can add value to each segment of the industry, and I hope to show you some of those data at the end of the day. So really, we don't have a lot of time, so I want to just show you, introduce the topic, show you some nuggets of information, and summarize some data at the end of preconditioned versus non-preconditioned cattle performance. Preconditioning is not a new topic. It's been around since the 60s, but our industry has been slow to adapt this management tool. We define preconditioning as a management, health management nutritional program designed to add value to calves and prepare them to withstand the stress of weaning. Really what we're trying to do is these major stressors, apply them to these calves early in their life before they're exposed to all these pathogens that happen at weaning and cell time and commingling of cattle. Stress is associated with decreasing the immune response. Some of those hormones that are involved in stress, data shows us that those are involved with, can inhibit the calf's ability to respond to the vaccine as well. So we want to apply these stressors earlier in the calf's life. So typically we want to begin preconditioning 45 days prior to marketing. We want to add, for this to work, we need to add value to the stock or feedlot producer who's buying these weaned calves, and hopefully they'll be willing to pay a premium to the cow-calf producer. And you just saw some data, 45 weaned-day-old calves or weaned calves versus those that have only been weaned for 30 or less. The economics of preconditioning for a cow-calf producer, I'll show you some data at the end that's going to show you there would be gains, increased calf weight gains, and also hopefully the premiums we just talked about, and that's offset. You're going to have the cost of feed, labor, vaccinations, and interest. So for to pay that premium, what's the value to your stocker and feedlot producer? Number one, we're going to decrease sickness, increase weight gain, improve feed efficiency, decrease drug use and labor, and increase beef quality. So there's good data, and I don't have time to go into all of it today, but there is good data to show these benefits to the stocker or feedlot producer. So really, again, our goal is to reduce stress at weaning and apply these major stressors like castrating, banding, dehorning, apply those before these animals are commingled and exposed to a high pathogen load or to diseases. So we're trying to apply these stressors early. So how do we do that? This is what we would recommend as a health program. This is not inclusive of all your vaccines and everything you need to do, but hopefully it gives you a starting place. At branding, I'm a big believer in castrating early. There's really good data behind this. We did a study when I was at Oklahoma State that proved this as well. I'd love to come back and talk to you about that data sometime, but I'm a big believer in castrating early, and I think that the data would show that. I'm a big believer in dehorning early as well. I also believe in implants, in implant suckling calves. Our product would be the component EC on a suckling calf. We also early on want to apply fly control. Stand guard would be our product. And then you want to vaccinate for your respiratory diseases, the respiratory viruses, and that would be our Titanium 5 product. And then also vaccinate for blackleg. We want to do this early on. You don't want to wait to vaccinate at weaning because, again, the stress of weaning inhibits the ability of that animal to respond to your vaccine. Really what we're trying to do is control BRD, and BRD has three factors. First, there's stress. Stress weakens the immune system. The hormones involved with stress weaken the immune system. When I taught at a college, university, same thing. At finals time, those kids are stressed and they're all sniffling and they're all sick. Same thing happens in that calf. They're sick. You've weakened their immune system from stress. Then a virus comes in, and these vaccines are trying to protect against the virus. And then the third component, the virus weakens the immune system, is you get a bacterial infection. So if you want to vaccinate later, another option, 4 months of age, same thing. Those respiratory, I'd recommend a modified live vaccine as well. But also there's some other vaccines that you could think about. That's our Mannheimia, Pasteurella vaccines as these calves get older, or if you haven't vaccinated for Clostridial yet. And then when it becomes booster time, we do recommend you booster with that modified live and possibly Clostridial if you need to. But we want to do that 3 to 4 weeks before weaning. We don't want to wait till weaning to do that. And again, it's involved with that stress and that calf's ability to respond to that vaccine. And if you do follow that protocol, at weaning, you're not going to need to give a vaccine. So we've already given our vaccine and our boosters at that time. We've castrated, we've dehorned, all those major stressors that contribute to that BRD complex. That's been done prior to weaning. Now, the other thing is nutrition. So health is a big component of preconditioning. Nutrition is a big component. Nutrition, we want to, these calves don't have any idea what feed is. We have to teach them what feed is. So that way when the stocker or the feedlot guy buys these calves, they know what feed is, they know what a bunk is. So we have to train them to eat, whether that's hay and supplement. We also have to train them to eat out of a bunk. And a lot of people forget this part. We have to provide adequate bunk space to these calves. 18 to 24 inches would be our minimum so they can learn to eat, learn what feed is, and teach them. Really, we're training them for the environment that they're going to see in the next stage of production in the future. What's the most economic nutritional program? That's really going to vary from ranch to ranch. A lot of times pasture and hay is most economical, but I am a big believer in forage testing. In my life before Elanco, did a lot of consulting, looked at a lot of forage testing, and you're going to have to provide a supplement, even if that's just a trace mineral supplement. But a lot of times providing a supplement in addition to your forage can maximize production and performance and be more economical. If you do provide a supplement, these weaning supplements, they need to be really palatable, because these calves don't know what that is. It needs to be something that smells good and tastes good that they want to go to and eat. And you want to feed a balanced ration, so work with your nutritionist or your feed company to do that. Again, I'm a big believer in implants. I would implant if you're going to retain ownership of these calves afterwards as well. So keep that in mind if you're going to retain ownership. One bug that's not talked about with preconditioning and weaning probably enough is coccidiosis. I'm a big believer that coccidiosis is one of those bugs that's just waiting for a time of stress to take over. It's in the environment, it's in our herds, and during times of stress, it can really take over. So we want to control that, and so our product to control that would be Rumensin, and we're going to look at that on the next slide. But I want to reemphasize before we do that, we're wanting to wean and keep these cattle on feed for 45 days to teach them to eat, and also to get this major time of stress through their system before we sell and we expose them to all these pathogens in the next segment of the industry. Real quick look at Rumensin and other anticoccidials. There's 4 drugs out there to control coccidiosis: Decox, Amprolium or Corid, and your 2 ionophores are going to be Rumensin and Bovatec. There's 3 products that are sidle, or they kill classified as cidal or kill the bug. That's going to be Amprolium, and then your two ionophores, Monensin and Rumensin and Bovatec. They both kill at 3 stages. The major difference there being that basically Rumensin is a more potent ionophore that works at about 1/3 the dose. And I believe that's a big factor when you're looking at starting these cattle, because when they're eating, their intakes are low, they're figuring out how to eat. If you can have a drug that works at a lower dose, I think that's beneficial to these animals. Also, an ionophore Rumensin is going to have the benefit of increasing a gain of these calves as well. So it's another, you're controlling coccidiosis, and then you're going to get improvement in gains as well in these young growing calves. So that's kind of an overview of the management component to controlling or preconditioning. Now I want to kind of show you the data. So this is the next 2 slides are from a publication by New Mexico State Extension, and I think they do a good job of kind of summarizing some of the data that's out there. We're going to compare these animals that were preconditioned versus not preconditioned and how they performed in the finishing period later in life. The South Dakota State data shows that there was no effect, but there's this Texas study, and there's other studies out there as well that did show an effect. So they showed an improvement in average daily gain, an improvement in feed efficiency, and a decrease in the number of days on feed. And so there's several other studies out there that, there's not a lot of really good data, to really evaluate preconditioned versus not preconditioned. You need really large numbers. You need multiple years to take the year effect out and season and those things. So you need really big studies. But these kind of give us an idea of how preconditioning cattle will affect their performance later in life. The next slide shows health benefits. Again, South Dakota, no benefit there, but these other 3 studies did show an effect. Colorado, we had a decrease in morbidity, quite significant decrease in morbidity, a decrease in death loss as well in those calves that were preconditioned. We had a decrease in medical costs in the Texas study, and also a decrease in death loss. And then the Oklahoma study by Dr. Lahmann's group also showed a decrease in morbidity as well as a decrease in death loss. So overall, I'm very comfortable saying that you can expect hopefully an improvement in gain and performance later in life, but that's certainly tied in to health issues, and you can expect an improvement in performance of these calves that are preconditioned. Why? Because we're not stressing them out at the time and applying all these stressors at the time when we're exposing them to these diseases by commingling, by shipping, and more stress. And so getting as much stress through that animal early in life does seem to be beneficial and provide a benefit to those calves later. So I appreciate the opportunity. I'd recommend you reach out to your extension agent, your veterinarian, or your Lanco rep, and if you need more information on some of these management decisions and preconditioning. So I want to thank you guys for the opportunity to discuss this as well. So I will now turn it back over and see if we have any questions.
Thank you, Dr. White. Looking here, I got my program up, back and running. I apologize. If you guys do have any questions, please feel free to email Lance or myself. Our emails are up on the screen right now. Pretty easy to remember, our first name and then at CattleFax.com, and we'll do our best to get back to you. We will post a recording of this webinar. We will email you here tomorrow, most likely is when that'll be. And it'll have a link to the recording so you guys can come back and watch this as well. And then kind of going forward, we do have a couple upcoming CattleFax events. We have a risk management seminar both in June. I believe registration may be closed for that and maybe still be open. I'm not in charge of that. You call the office or email one of us and we get in touch with you who can. And then end of September, middle of September as well. Corporate college, a little bit different field to that, more of a general overview to the cattle markets in July. And then our next Trends Plus cow-calf webinar occurring at the end of August 29th. So with that being said, I believe Lance wants to get one question answered here before we sign off. I want to thank everybody for participating. I want to thank Elanco for sponsoring this and making this a free webinar for everyone here attending, and those all who registered as well. I want to thank Dr. White for coming on and sharing that information with us. That was helpful and really really went along with some of the stuff I shared in the cow-calf segment as well, or cow-calf survey segment as well. So Lance, I'll let you go ahead and answer the question.
Yeah, the one question that came across here that we can answer easily to the group is, will a continuing positive basis, in other words, the premium we have in the cash market relative to futures, allow cattle feeders to avoid the temptation to hold and carry cattle? I think that becomes a question. It's almost like chicken or the egg. Is the carrot bigger than the baseball bat? And I know that sounds crude, but that's the reality. You know, the cash premium that exists obviously is a clear incentive, and the person asking the question recognizes that, you know, the cash market has a record-wide premium in it relative to the underlying futures in the nearby, and that's a huge incentive for cattle feeders to ship cattle now. There's no doubt about that. The problem is that signal becomes a little bit muted when all of a sudden you start losing money on these cattle. And we're certainly going through that transition today, with literally cattle in the month of May being the first ones this year selling under their break-even price. And it's only going to get exacerbated as we work through the rest of this year. And if you remember earlier in this deck, we talked about that August-December price spread, and it's near record wide. Now, granted, December doesn't look nearly as juicy today as it did 30 days ago. And I think we all recognize that, whether we're participating ad hocly through this market as a cow-calf or feeder cattle operator, or we're directly involved in that market as cattle feeders. But what it really becomes is, what opportunity exists as they add that weight, add those days. You know, what are the benefits and trade-offs? I would tell you today, very much so. Guys are moving cattle quickly and trying to take advantage of it. Our feed yards on average are very current to at least current in their marketings. But as we work through some of these cattle, as they have some available pen space, and as these placements continue to be less available to them, the best thing they can do is keep the hotel full. And they clearly can't buy one that's going to come into the feed yard that's not going to lose any more money or less money than the one they have. And so I think it's almost a case-by-case scenario. Basis is going to correct. We know that. It can't stay record high forever. That doesn't mean that cash is going to invert itself relative to futures. That's a possibility and certainly a risk that we need to watch out for. But we know with certainty it's going to collapse. And it's going to collapse most in the next 30 or 40 days. And it's to what extent then does that spread gain attractiveness over the basis that's there today? And we just got to see how that plays out. We think it's a risk factor. Is it a given? No. And I think that's the point of the question being asked. And we just got to watch that very carefully and see how that could potentially influence those of you on this call who are feeder cattle and calf sellers. So with
that being said,
yeah, go ahead, Ethan.
Yep, thank you, Lance. Thank you, Lance. We appreciate everyone with attending. We'll be sending out a follow-up email with a survey link to help us improve. We'd really appreciate your feedback on that. In the next coming days, like I said earlier, we will be sending out a recording on this with a link to the recording. So we appreciate everyone for attending, and we hope you all get plenty of rain and have a wonderful summer. Thank you.